Welcome to this video. This is 1stusFx. Now, by now you should know how to identify order blocks. If you do not know how, on your screen right now you should see an example of what an order block looks like. And just a reminder, we said order blocks are usually areas where institutions take their orders from, and obviously that is why the name is called order blocks. So a lot of orders come from those areas, and usually you find them at swing points, swing highs and swing lows. All right, so you do not want to just mark out order blocks because you find a lot of them on the market, but you want to take note of the significant ones, which are always at swing highs and swing lows. And usually order blocks signify a continuation of a trend when it's in an ongoing trend, and if it's at the beginning of a trend, it signifies a change. All right, so usually you see an order block being formed whenever the market wants to change its its trend. So take for example, if the market is in an uptrend, all right, it makes a high and makes a low. Let me do this again. So the market is in an uptrend, it makes a high, makes a low. Now before the market makes a new high, an order block will be formed at this low before we would see an explosion. Price comes down. Before the market breaks structure again, an order block will be formed, goes higher. So usually people use these order blocks that are formed around here for entries to continuation, and that's where you have trend lines. So you usually see a trend just like this. Hope you got that. So basically that is the idea behind order blocks. So now we want to talk about how to use them effectively when you're trading in the forex markets. So you don't just go about marking out all the order blocks you see. So every time you see a down candle, you just mark it out and instantly buy. No, so you want to take note of them. So like I said in our previous video, or if you've attended any of our classes before, you always want to pay attention to the higher time frames, because the higher time frames are where institutions take their trades from. All right, we're talking about the 4-hour time frame, daily, and all of that. So when you identify order blocks from these time frames, they usually hold very well, and those are the areas you should look at for. So I want us to go down to, let's use a Euro USD for example, and let's use the daily time frame this time. I want us to use the daily time frame to identify order blocks. All right, so here we have the daily time frame on Euro USD, and clearly here you can see we had a shift in the structure of the market from here. So the market has been in a downtrend, as you can clearly see from the charts. Price came down here, made this high, made a new low right here, and then we had a shift here. We had a shift here, a higher low, and then continuation. So you can see where the shift started from. So we had a change in character from here. So this was the last high that was created before we had a shift. Now the first thing you need to ask yourself is, where are the orders coming from? Where are the buy orders coming from? Because this is our swing low. This is our swing low. This is the swing low where the orders are coming from. So you want to ask yourself, where is the last bearish candle before this shift? This is it. I hope you can see it here. Now you can use the entire body, or you can use the entire candle. All right, personally I like to use just the bodies when I'm making analysis from the higher time frame, so you can see there. Remember what I taught you about the video on order blocks, how to identify order blocks? You would notice that the candle closed above the open price. I hope you can see it. It's very, very clear there. and then we had a little bit of consolidation, another push up, and all of that. So some persons may already see this and they want to quickly buy. Some persons may identify this as their order block and they want to buy from here. Initially there's some reaction, but then what do you see? Market dips further. All right, why did the market dip? Because you do not want to buy when the market is high. All right, you want to buy when the market is low, and usually we buy when price is at discount, when price is below equilibrium. So if you take your Fibonacci, for example, from this low to these highs, you know the areas to buy is below the 50% level, which is around this zone. So you want to identify order blocks at the discount area, and this is our what? Order block. I hope you can see that. Now you can identify this as your order block. Some persons will also use this small one we have here. It's also good and fine, but you must understand when an order block is invalidated. It's invalidated when the low is taken out. Let me take out this Fibonacci. So this is where we do not want to see price go below this low. If price goes below this low, this order block is no longer valid. So as long as price stays above this swing low, buying is still valid because we have a shift in the market structure. There's an order block from here, and this is where we expect the market to buy. And your guess is as good as mine. The first time the market comes to this order block, we see an instant reaction. You can see the reaction. See how the market closes bullish. Market goes high and comes back into the order block again for another opportunity. So everybody that missed out on the buy from the initial bullish run had an opportunity to buy again from here, and then the market went high. Now we obviously know that the market is going to take out this high here. Let me mark it out right here. So we know the market is definitely going to take out this high. So but what do we see? We notice the market dips again. So we have these bearish candles here that the market closed above. So we can also use this as an order block for another what? Entry. Hope you can see that. So this is it. So if you mark out this on your daily time frame, when you go down to a smaller time frame to look for entries, you look for entries within this order block. Within this order block. So you're only looking for buy entries within this order block. So basically this is how to use order blocks. All right, now you can also use them as continuations. All right, you also want to use them as continuations. So let me give it an example. All right, so you notice that this is an order block right here. This is a bearish candle. I hope you can see it. That price has not yet mitigated. So price just kept buying, and then eventually price came back to it here, and that is where the market bought from again. Hope you can see it. So this is another type of order block. This is another order block here. If you notice, after price closed above it, price did not come back to it until this candle we see here. This candle we see here. Just mitigated it and then bought from it. Now if you use the bodies of the candles, you most likely would have missed out on this trade. So you would have missed out on this trade. Okay, now this is just a basic example on how to use order blocks. Now there are what we call breaker blocks as well. Breaker blocks. So when we say breaker blocks, we're simply saying that order blocks have been invalidated but can still be used. So basically, just like we have IFVG, which is inverse fair value gap, we're saying that when we have order blocks that the market breaks through suddenly, we can use those order blocks as support becomes resistance, or resistance becomes what? Support. So let's look for examples so I show to you how they look like. So this is a very practical example of how it looks like. So right here you see we have this order block right here. You would notice that price had not yet mitigated, so price has not come to it after it was formed. When price broke through it, it became a what? A breaker block. So it becomes what? Resistance now turn support. So this is another way to catch entries. This is another way to catch what? Entries. If you look at this is an order block right here. Immediately price closed above it. Notice it became what? Support right here. You can see that, and we had this bullish run. I hope you can see that. Let's look at another example. Let's see if I can find another example for you guys. Okay, so this is another example of an order block right here. This is a daily time frame, by the way, so you can see the market reacts to it. I hope you can see that. So the market reacts from it. Let's see if I can find another example. Alright, so this is the daily time frame. So let me take you down to the 1 hour time frame, because most persons will not be trading from the daily time frame, because obviously you're not a market maker, but you find them a lot on any time frame. But you want to always go back to where is price coming from. So if I look at this chart right now and I ask myself, where is price coming from? It's very clear to me that price is coming from here. So this is the last bearish candle on this time frame. That is an order block. So basically what I'm saying is that I'm expecting price to dip itself down to these levels. But then before this order block was formed, there was a previous order block right here. Can you see? So we had this series of bullish candles right here that was supposed to act as an order block for the continuation of itself. So we're expecting price to retrace here and come down. But instead, price broke through it. So price broke through it. So we expect price to come back here. So resistance becomes what? Support. So instead of using this order block at the bottom, we're using this. Now this also aligns with our knowledge on Fibonacci. So you notice if you take the highs and the lows of this range, you will notice that price is very well around our discount zone, 61.8% level. So it aligns very well with our Fibonacci buying zone. So instead of using this as our order block, this is what we use for this trade. I hope you understanding how to use order blocks now. Okay, so you do not want to just buy from here. Take for example, this is an order block. So some persons may want to buy from here, this order block. And now you can see initially the market, if you use the entire candle for example, you see the market reacts to it, but then the market closed inside that order block. Now this should not be wise because currently price is too high. So for you to buy from here, it means you are taking a lot of risk. You want to see price come to the discount zone before you buy again. Let's look at another example. Clearly, you can clearly see that the market was in a downtrend. I hope you can see making lower highs and lower lows. So what do you notice at every point of reversal? Okay, so take note here. Here we had this order block right here that the market reacts from. I hope you can see it. Next time the market retraces, comes back to this order block and sells off. Hope you can see it. Next time the market comes back to this order block and sells from it. Now next time we see the market reacts from this buy order block here. Hope you can see this buying order block. That's where it reacts from and buys off. But then we also have a sell order block right here that the market reacts from. Hope you can see that. So order blocks, you always want to use them at the beginning of where the whole market structure shifted from. You don't want to use them at the middle, except there was a break of that order block. So that order block becomes resistance if it was a support, or becomes support if it was a resistance. So notice this is a practical example. So anybody that sold from here, for example, anybody that sold from here, if they were hoping to take their profit at these lows, guess what? There was an order block resisting price from going below. So some persons use this as another block for sales, and that's why you see the market reacted from there. Hope you can see it. And so other blocks are also ways to tell you where you should keep your targets. All right, especially if you're not a swing trader, if you're a day trader. All right, so the market does not reverse back, so you don't lose all the profit you've made. Do you understand that? So basically, this is how to use order blocks and all of that. So guys, I hope this was clear enough. When you watch the videos on putting it all together, all right, it will make more sense. But on this video, we're just talking about how to use just order blocks. If you notice, we did not talk about liquidity, we did not talk about fair value gaps and all of that. Now, how do you know an order block has been mitigated? All right, so that brings us to what we call consequent encroachment. So you notice that every time we have an order block, sometimes price reacts from the beginning of the order block, sometimes price gets to the midpoint of the order block, sometimes price goes way past the entire order block but then closes below it. So how do you know an order block has been mitigated or it has not been mitigated? All right, so what you want to see is that price at least touches the body of the candle, and that's why I like to use the body of the candle. So during this, when price comes back to the order block, we want to see price at least touch the body of the candle, not just the wick. Why? Because the main orders on that order block are in the body of the candle, not the wick. So you want to see price touch the body of the candle and not just the wick. I hope you got that. So let me give you a good example here. This is an order block. This last bullish candle you see here. Now, if you notice right here, if you notice, the body of the candle started from the midpoint. This is where the body of the candle started from. If you notice, price touched the wick of that order block but did not get to the body. What do you notice? Price comes back to it again right here and eventually sells off. Can you see how the sell was very massive? Sells off and takes out these lows. Can you see that? So this is an order block that was formed May 18. Price eventually mitigated it on May 27th. That's like 9 days after. Are you seeing that? So if you took note of this trade, if you use the bodies of the candles to take this trade, we would have caught a 1:7 or 1:8 trade, and you are good to go. So guys, I want to ensure the videos do not get more than 20 minutes maximum, so you can watch them. So guys, if you have any questions, ask on the comment section. Make sure you subscribe, like this video, and you share it as well. Till next time, I'll see you.